So if you've now decided that you want to use privatized banking, this system and process that we've described that helps you to be able to control your capital, build it where you have access to be able to use it, you have safety, you have liquidity, and it's growing and compounding, and you're able to borrow against that capital, using it as collateral, and use it somewhere else in another investment, earn a second rate of return on that same money, while you still earn uninterrupted compound interest on your own capital. If you've now made that decision, you know that behind that strategy is a product called specially designed whole life insurance. Now, we want to help you understand what goes into this insurance product that makes it compatible and capable of being used as a privatized banking system. Now, there's many different kinds of life insurance, and when you go shopping, it might feel like you're standing at Baskin-Robbins and there's 31 flavors in front of you, and you say, well, how do I know what to pick? So I want to give you a framework or a map to be able to overlay on any life insurance product that you're looking at so that you have the way to determine, is this or is this not what I need if I want to use the privatized banking concept? The first thing we want to look at is what type of life insurance is it? Now, life insurance really falls into three main classifications or buckets. The first is term life insurance, the second is universal, and the third is whole life insurance. Now, term life insurance is just as it sounds. It's for a term or a specified length of time. Now, this is usually 10, 15, 20, or 30 years, and usually what happens is you're paying in premium for a death benefit that will pay out if you pass away during that term. Now, within term insurance, there's no equity buildup or cash value. So there's no access to your money. It's simply a death benefit product. Now, it can have a very specific use in supplementing and adding on to other life insurance products to increase your total death benefit and get closer to your human life value. Or it may also be used as a temporary strategy where you put a convertible term policy in place and then later convert that over to whole life. You also might be looking to expand your ability to have more whole life insurance later, regardless of health status changes. And so we often see people might put a term policy in place knowing that they want to convert all or a portion of that over to whole life, in addition to other life insurance products that they may already have in place. Now, all of that being said, term life insurance as a standalone product is not sufficient to use for privatized banking. Let's move on to the middle category. This is universal life insurance. Now, universal life insurance is kind of a hybrid or a mix between term life and whole life insurance. You're getting some cash value or some equity buildup, and it's often not quite as high of a price point in terms of premium. But there's a lot going on inside of a universal policy that makes it unstable and not enough guarantees to be used for privatized banking. One of the key reasons why this is the case is that sometimes within a universal product, be it universal, variable universal, or equity index universal life, sometimes the premium that has been illustrated is not sufficient to keep the policy in force as it's illustrated, and more premium is needed to keep the policy from imploding. Now, that's not much of a guarantee that we need to be able to put underneath us in the privatized banking strategy. Now, the third bucket of life insurance is whole life insurance. This is also a permanent life insurance product, as is universal, but there's a lot more guarantees. First of all, you're getting a guaranteed premium, meaning you'll never have a premium increase in order to make the policy perform. Second, you have cash value growth. So within the policy, you have access to your cash value, which is a portion of your death benefit that you can use. Now, the type of whole life policy that we use is only with a mutual company. And the reason that we use a mutual company is that within a mutual company, all of the policyholders are actually the owners of the company. So by contract, when the company is profitable, they distribute their profits to the policy owners in the form of a dividend. And so that's declared at the end of each year and paid into your policy. That's another way that you earn growth, and then the dividend itself earns more dividends and interest. Now, one of the key reasons that a lot of times people are disenfranchised with whole life insurance is that they feel that it takes forever to build up cash value. And I have seen this where it takes maybe 20 years to have access to sufficient cash value that you'd be able to do something with. And so that tends to be this turnoff for a lot of people. But the key is that there's a way to structure the funding that goes into the policy so that you have as much early cash value as possible and as much long-term growth. And that is what's necessary for privatized banking. Without going into too much technical details, a lot of whole life policies are structured with only base premiums. This is the foundational premium or payment that goes into a whole life policy. And that base premium builds up a lot of dividends over time and has a lot of long-term growth, but has very little cash value. There's another type of premium called paid up additions, and it's called different things with different insurance carriers, but that portion of premium buys only a small amount of death benefit and a lot goes towards cash value. So you want to structure the policy in a way that you have a lot of paid up additions going in so that you have early high cash value. Now, this is what makes the policy really be supercharged. It's not your traditional whole life product that takes forever to build cash value. Instead, you're seeing access to as much as even 60% of the money that you put in, even in the very first year. And usually we're seeing a break-even point where all of the money that you've put in is now available to you and more, and the growth just goes beyond that. We're usually seeing that between years 5 and 7, sometimes up to year 9, depending on the age and the health status of the person being insured. So there are some adjustments and reasons to make changes to make sure that the policy is maximized for you. But let's just recap. Here's the things that you need, almost like a map to know exactly what you're looking at to make sure that it will work for privatized banking. A, it needs to be a whole life product. B, it must be with a mutual company where you're going to earn dividends. Now, on top of those dividends, you're going to have the cash value growth. And then you also want to make sure that you have the funding structured with paid up additions riders to make sure that you're maximizing the early cash value. The last thing I really want to point out is you want to make sure the policy doesn't mech. Now, this is simply fancy insurance lingo, but what it means is that without meching, a life insurance product is designed to pay tax before you put the money into the policy. Then as it grows, the growth is not taxed. It's tax-free. And then if you use the policy correctly, it's also not taxed when you use the money. Now, if you don't fund the policy correctly, what can happen is you lose those tax advantages and it switches over to like a tax deferred vehicle where you don't pay tax when you put the money in, but you do when you take it out. And that's what we don't want because we're losing too much of that tax advantage that really makes it attractive in the first place as a tool to store your cash. So I hope this is helpful to you in figuring out what exactly your life insurance product needs to look like in order to maximize the benefits and advantages of privatized banking as a place to store cash where you have maximum growth, safety, access to your capital, and you're able to have that uninterrupted compound growth inside the policy even while you use the money somewhere else. Hey, I hope you liked this video. If you did, click the link in the description box below for more information. And don't forget to like this video. Share your comments, questions, and feedback in the comments section below. And don't forget to hit subscribe to our YouTube channel.